This episode is part of the pool's Local Officials Stronger Together podcast series. It's one way we serve local officials through integrity, public service, fiscal responsibility, and operational excellence.
As always, please direct specific questions about coverage to your risk management advisor.
Welcome to episode 45 in the TML Risk Pool Stronger Together podcast series. I'm your host, Scott Houston. Cities and other local governments aren't required to go through a formal procurement process to join the pool. That's because they're essentially self-insuring when they do so. Now, that being said, many do a process and for various reasons. And when they do, we're of course happy to follow that process to ensure competition for apples to apples coverage. That apples to apples part is what we want to talk about today. And to do that, I'll be visiting with the pool's Director of Risk Services, Aaron Hardiman. Aaron is a frequent guest on this podcast, and he's super well-versed with insurance procurement after working for an insurance company and for a larger Texas city. So let's get right to it. Welcome back. Now, the ultimate goal of this episode is to help public officials understand what fair insurance procurement looks like and how to spot red flags in that process. So let's visit with Aaron about his thoughts on these issues. Welcome, Aaron.
Great to be here, Scott.
Hey, we're really glad you're here again. So let's walk through some major categories and questions that public entities should ask when they're procuring insurance. First, let's talk about procurement integrity and independence. Why is it important that the public entity controls the RFP and the scoring process?
Hey, Scott, it's extremely important that public entities control the RFP and the scoring process because that's the only way to ensure that procurement is objective, transparent, and free from outside financial influence. When a vendor or broker shapes the scoring, they can engineer the process to favor themselves or a preferred carrier. Public entities have a duty to protect taxpayer dollars, so they must own the criteria and the scoring and obviously the final decision. That keeps the process accountable, defensible, and aligned with the entity's actual needs and not the private party's revenue model.
Okay, got it. So you use the word broker, and I think sometimes we take for granted that all our members know what a broker is and what a broker does. So before we go any further, just tell us, what is an insurance broker and what do they do?
An insurance broker is basically a retail broker to get you access to insurance coverage. Their job is to understand the entity's risk, the market, and to negotiate terms to try to place that coverage for the entity. They're typically going to be paid by commissions or fees, so they are financially tied to the transaction, even though they're supposed to advocate for the insured.
Right, so they're really there to help you through the process. And so that means when a broker also acts as a consultant in the procurement process, that can cause risks to happen. What are some of those risks?
Yeah, some of those risks is, that the broker's serving as the advisor and the seller. So that entity loses true independence. The broker has a financial incentive to steer specifications, valuations, or program designed towards the markets that benefit them the most. That can result in biased advice, incomplete options, or coverage structures that protect the broker's revenue instead of the entity's risk.
So the broker isn't necessarily always going to be the public entity's friend. What are some kind of disclosures that should be required from anyone who's going to be advising the entity on procurement?
Yeah, Scott, brokers and consultants should disclose all of their insurance licensing, as well as broker affiliations and carrier appointments, as well as compensation arrangements, including commissions or contingent compensation.
So you mentioned a carrier appointment. Tell me what that is. What is it when a broker has a carrier appointment?
So, Scott, typically in the private insurance market, a carrier appointment means you have a contract with a insurance carrier so that you can write that coverage. So that also means that a broker won't have access to all markets available. So a lot of times, if they don't have that, then they'll go to what's called a wholesale market. And those wholesale markets have contracts with all the carriers, but then typically the cost might be a little bit more because then there's two sides of the commission transaction on those.
Wow. So this does get pretty complicated pretty quickly, doesn't it? How can a public entity, a city or other local government verify the independence of their broker or their consultant?
Through the RFP process, it should not be outsourced. Policy decisions and private parties with financial interest in the outcome. Independence is verified through competitive solicitation, clear separation between being the advisor and the broker functions, and requiring advisors to certify that they have no financial stake in the bidder's placement.
Wow. Yeah. So that last one seems like the most important, that there's no financial stake for the advisor. So what are some of the red flags that a local government that's doing a procurement can look to? What kind of red flags signal undue influence over their bid specifications?
So what we've seen in the past, Scott, is we've seen where the RFP design will include specifications that mirrors just one carrier's coverage word for word. Or a lot of times they will alter the valuations on schedules, which will then equal a lower rate at the time of quoting. There's also, I've seen cases where there's been must-have requirements that eliminate other competitors, and a broker writing the RFP for the coverage that they also intend to sell is a really big one. Also, you might see where they will limit the timelines associated with the RFP process, and any situation where the advisor is controlling the information flow to the decision makers, meaning that the information is going to the broker or the advisor versus the city.
Okay, so those are some red flags to look at when they're dealing with bid specifications. So, and those, of course, relate to procurement integrity and independence. So let's talk a little bit about coverage structure. And I think this is probably the most relevant to that apples to apples comparison. What is the difference between a claims made and occurrence-based coverage?
So an occurrence covers losses that happen during the policy year, no matter when they're reported. A claims made covers losses that are reported during the policy year, regardless of when they occurred. And those are subject to retroactive dates and tail coverage. With occurrence, the event locks in the coverage. With claims made, the reporting timeline and retro date determine whether the claim is covered.
So all that can be very complicated too. And I know you wrote a memo on this or a paper on this not too long ago. We will link that paper underneath the podcast so folks who want to learn more about that can do so. And so why does it matter whether defense costs, attorney and other costs are inside or outside the policy limits? This is a big one, right?
Yeah, absolutely. This is a really big one, because if defense costs are inside the limits, every dollar spent on attorneys reduces the amount left to pay a judgment or a settlement. In big cases, the defense can burn through the limits before you ever reach damages. When costs are outside the limits, the policy pays defense separately, preserving the limits for the actual claim, which is especially important for public entities exposed to high defense lawsuits.
One of the things that we talk about a lot in this podcast is the Texas Tort Claims Act. And basically, very simply, what it means is that for certain state law claims, there's a cap on the amount of damages that's set out by the state legislature that a plaintiff can receive. But those become very important when you deal with public entity coverages. How do tort cap endorsements work, and why are they a major risk for our public entities?
So basically, we've seen the case where a lot of privatized carriers are putting tort capped endorsements on their policies. So basically, those are going to limit the insurer's obligation to the statutory cap, not the policy limit that was paid for. The danger is that they shift any amount above the cap back onto that public entity. So even if you bought higher limits, the endorsement can erase the protection. Public entities with statutory caps can get caught thinking they have $1 or $2 million in limit when their policy may actually cap coverage at a fraction of that.
So those are some examples of coverage structure issues. Let's talk specifically about property coverage now as an example of some of these traps for the unwary. Why do some brokers recommend reducing property values? What risk does that create?
Yeah, some brokers will undervalue property to reduce the premiums and make their quote look cheaper. The risk is severe. Underreporting values creates coinsurance penalties, inadequate limits, and disputes at a claim time. If a catastrophe loss hits, the entity discovers the savings were actually a hidden coverage reduction.
Wow, so that's a pretty simple one. That's easy to understand. They're just saying you don't have as much to insure as you actually do. So that ends up being a problem if there's a claim. What is a coinsurance clause and how can that penalize a public entity?
A coinsurance clause requires that an insured carry coverage up to the percentage of the property's true value. Often we'll see 80, 90, or 100%. So if the entity reports lower values, even on a partial loss, the carrier can reduce payment proportionally. So a $1 million building insured for $500,000 could result in the carrier paying only a fraction of the claim because that entity didn't meet the required value threshold.
So what does apples to apples really mean in property insurance comparison? It seems like there's a lot of different components to these things.
Apples to apples means comparing identical valuation methods, limits, deductibles, coinsurance clause, special form versus named perils, ordinance and law coverage, debris removals, and replacement cost definitions. Two costs are only comparable if the underlying coverage, valuation, and conditions match line by line. A cheaper quote is meaningless if the structure underneath is weaker.
I think that last thing that you said is probably the summary of this whole episode, right? Which a cheaper quote is meaningless if the structure underneath is weaker. So you've always got to make sure you're comparing these policies and they're providing the same coverages and all the same information. So this is a ton of great information. Thanks for joining us today, Aaron.
Absolutely. Thanks for your time, Scott.
Okay, so let's do your action items for this episode. Let's just do 2 today about ways you can ensure fairness and transparency in your insurance procurement. Action item 1, avoid vendor-driven RFPs. Instead, use independent consultants if you need to by confirming that the consultant can't also bid on the coverage. Your entity should also review and approve the RFP, distribute it, and receive all responses directly. And then action item number 2, understand that just as in other areas of life, if a quote seems too good to be true, it probably is. And most importantly, ensure apples to apples comparisons between bidders' products. The bottom line is that protecting taxpayer dollars means more than choosing a low premium. It means ensuring the coverage works when the community needs it most. Fair, transparent procurement protects the public, strengthens trust, and ensures public entities are properly covered. So that's it for this episode. Thanks for trusting us and tune in to another episode soon.
To review written materials associated with the presentation or to ask Scott a question, please visit www.tmlirp.org and click on the Stronger Together podcast link. Please remember that the information in this episode is provided for informational purposes only and doesn't constitute legal advice. We recommend that you review the podcast and the accompanying written materials with your attorney prior to taking action.